All right, welcome back. This is John Nazar, Remax Results. Thanks for coming today. I have Ivan Oberon with Edge Home Finance and Your Kingdom Lender. He's going to talk to us about ground up construction for builders. It's a unique product, again, something you're not going to find in all markets, but Ivan can get it done for you. So, with that, Ivan, tell us a little bit about what you're going to talk about today.
Yeah, thanks, John. Always happy to be here with you. Thanks so much. And one of the things that really gets me excited is creating solutions. Right. So, in 2023, I decided that I needed to be play a role in helping to solve the inventory problem. And how do we do that? Well, how do we better resource the builders and the people actually building these homes to create the inventory? And so that's why I started focusing on connecting with small to medium-sized home builders across the nation and helping them create their build out their subdivisions in a variety of different creative ways. And this is that specific loan product targeted specifically for the home builder or developer, not the end user. Of course, we have a lot of great products for that and making sure that the builders find qualified buyers. But this construction loan is meant to give the builders a majority of the funds required to develop their subdivisions. And of course, we can start pretty much at any part of the construction after they've purchased it, whether they need horizontal development, whether they need vertical development, whether they need them both. And there's a lot of creative things that we can do for our home builders here.
Would it be for the acquisition of the land, the maybe the engineering, putting in the roads, or is it just finished lots?
So generally speaking, when you're talking about putting in the roads and doing that sort of thing, that's what's called horizontal development. So
Okay.
that's after you've already bought the house. That's pretty much after you've completed your initial entitlements, if you're buying a raw piece of land. Sometimes developers and builders aren't buying a raw piece of land, right? They already have, they're buying a piece of land that's at least entitled to say, build 29 homes in this particular subdivision. And then they need to go, finalize the process to get those permits approved and finalize, get their models going, get their renderings and plans and permit submissions and all that kind of good stuff before they can start either their horizontal developments, putting in the curbs, putting in running the power, running the water to, depending on how that looks like in that particular development at that time. Maybe put paving for driveways and for streets. All that stuff is the horizontal development. And the vertical would be, okay, now we're ready to build this house. Right. So our construction product and partners and investors have the ability to provide both types of loans, one
Hmm.
that includes all the horizontal development and the vertical development as well. They're very selective and protective of that because these guys technically are not in the business to do horizontal development. They want the whole thing. So they just want to create that relationship to where as they close the loan and you're going to do the horizontal development, they just want assurances that you're going to continue through that loan to do the vertical construction as well.
Okay. Could somebody, a developer, pick up a piece of land that's already zoned for, let's say, 6 units, and then get the money, from you to go ahead then and finish those off and then build at the same time? So they're going to do the whole thing?
Yes.
Okay.
Yes, there are obviously like any other loan, there's certain qualifying parameters, but generally speaking, yes, because that would be part of their total budget and scope of work. And there's two different times where we run into people, and generally I catch people kind of on the further end where they're almost ready to go vertical, right? But if we're not there and they need some of those funds for the horizontal development, that will just be part of their itemized budget and scope of work that'll be submitted to the lenders for approval. And then that'll be part of how they would start the process when the loan actually closes. That'll be part of their draws. And like whether it's that process or you're down the road ready to go vertical, we can use what we call your overall sunk costs. So let's just say you already bought the land and you've put a little bit of money into it. Maybe you started the architectural process. You've come out of pocket for certain things. All those things that are quote unquote sunk costs can be added to your overall cost basis as equity contributed, and it will help increase your loan amount because it'll go towards the cost basis for what's called the loan to cost. And when typical buyer goes to buy a home, there's what's called loan to value because now they're buying a home. They use a loan to cost. Okay, what's our overall cost? How much did we buy it for? How much have we spent so far? What's going to be the construction budget to finish this whole thing? Maybe what are even some of the loan costs, right? Because some of our partners will actually include loan costs towards the overall LTC, which can help give us a little bit larger loan amount to cover some additional expenses needed by the builder.
And can they pull a couple of specs at the same time? Money for that to do specs, or is that a separate loan to do a
Sure,
spec build in there?
sure, we can do that as well, and that helps me think of something that's very critical to our builders, especially ones that are looking to build multiple homes in either a subdivision or at once. What a lot of our builders run into an issue with some of the local banks and more conventional type lending partnerships that they have had is an issue with the number of starts that lender will allow. And what that means is, okay, we have a certain pool of money that we're going to use to build these 2 or 3 or 20 homes, right? And the faster a builder can build and sell, the faster they can recover their expenses and make their profit, right? So we want to be able to have that done. Many banks out there are only allowing maybe 1 or 2 starts. But imagine if a builder can actually have the capacity to build 3 or 4 or 5 homes at a time and get that economy of scale, buying materials for all those, reduce their costs, and also reduce their holding costs because they're able to finish the projects faster and sell the homes off more quickly. So that's one thing that we're really picky about is, hey, we don't want to limit our builders with
Hmm,
a very limited number of starts and also a cumbersome draw process, right? So our third-party fund control people of several of the investors that we work with, they're very efficient and they can get that money turned around so that our builders can pay their GCs, their subs, and everything, and keep everybody happy in the project moving forward.
very interesting. Okay, and is there a loan to value that a loan to cost that you try to keep it at? Um,
Well, the most aggressive loan to cost right now is about 85%
okay,
loan to cost. So what I find when working with most of my clients, depending on where they are in the process already, when they come to me, that 85% will generally end up covering 100% of the construction dollars that they need because they've already, they have other costs, right? They've already bought the land, they've put some
mhm,
money towards entitlements, they put some money towards pre-development. And so they're coming from already a place of equity that we can use towards that. And so 85% loan to cost will typically get them all the way there, if not most of the way there.
sure.
Of course, if they don't need that much, right, you custom tailor the leverage and the loan size depending on what each individual builder needs. And if a builder is more flush and has cash, and it's like, I want to reduce my overall expenses, so I don't want to take the max leverage. I only need 70% LTC. Then of course we can tailor the loan to any of those things. And then pricing, you can sometimes get even a little bit of pricing or incentives because you lower the loan to cost, you lower the risk. So we can get some of these lenders to incentivize us with maybe a little bit of a better rate or cost.
Okay. And what is a typical length of a loan? Like, is it good for 18 months, or is it, like hard money sometimes is 12 months? Or is this 3-year deal? Or what's the length of time from my time I actually take
It,
money out?
it is project specific.
Okay.
Generally, it's going to be 12 to 24 months.
Okay.
On some bigger developments, for example, I was doing 49 condo development, 49 unit condo development in Pasadena, California.
Hmm,
That was set to be a $42 million loan.
wow.
And based off of how he was projecting his builds and how he was going to sell and all that kind of stuff, he asked for a 36-month term with potential extension options. So,
Okay.
so certainly there's different ways to customize things, and part of it also depends on your overall loan amount, right? As the loan amounts increase, you have different buckets of loan amount ranges, like say 2 million to 5 million, 5 million to 10 million, 10 to 15, 15 to 20, 25 and above, 30 and above, et cetera. So your guidelines do change a little bit. Your LTCs can change, but also your parameters, because you have a bigger project that we know is going to take longer. The idea is, what's the longest term we can give you up front to set you up for success and prevent you from having to maybe pay an extension fee if your project runs a little bit longer than you expected. So it's all this industry and this space and this program is very customizable for each individual builder. It's not
Hmm.
a cookie cutter program like you would say, a borrower coming with a conventional loan to buy a house, very cookie cutter, everything's the same. This is very customizable.
Very interesting. And is there any type of contribution as far as equity, or is this just a straight loan so that if they borrow the money, they don't give up part of their project or anything like that? How does
No,
that
this
work?
is this is straight debt.
Okay.
So nobody's taking equity out of their project. The equity contribution would come from the borrower or the builder in this case by way of either sunk costs, or if they're buying a new project, let's just say they're buying a project and it's ready to go. Well, if the max LTC is 85%, or 80%, then either way, they're contributing 15 to 20% equity themselves, right? By
Hmm.
form of a down payment. So either way, yes, they're the builders, the borrowers, that there's going to be some kind of contribution. It doesn't necessarily have to come out of their own pocket. Many of them might have investors that may partner with them, that either they give equity to, or they give a flat rate of return. It just depends on how the builder is set up.
So it doesn't have to be the builders per se, but it has to, like a builder could create an LLC of some sort, say to their, give them like mezzanine financing or whatever, so they'll give you a higher preferred payout for that down payment, and then I'm gonna use that. So I mean, not that they're gonna do 100% financing, but essentially they could if you
I
don't
mean,
source the
yeah,
down payment, they don't
essentially,
care about that.
right? The lender wants the borrowing entity, right, the LLC or whatever, to have skin in the game, right? That nobody's
Sure.
going to offer 100% financing. Yeah, it might not cost you any money from this point forward, right? Based off of your sunk cost to date. But yes, you can create an LLC. Let's just say you're the primary sponsor, and
Hmm.
you're the one that's going to be managing the development, and then you have another sponsor or borrower or partner who's actually the GC, and then you have one smaller partner, like a 20% shareholder partner, that's the capital, and he's the investor. And you agree to whatever you're going to give him, right? You're going to give him a certain flat rate of return. You're going to pay him simple interest every quarter. It doesn't matter how any of that's set up. It's just, okay, the money is still coming through the borrowing entity
Hmm.
structure based off of who's on that operating agreement, right? So there's really no need to source where the money's coming from, other than sourcing that there is the money there to close the loan,
Sure.
right? Because that you want to make sure that you don't run into an issue in escrow, that all of a sudden, okay, if there was money needed to close, you need to proof up and show that you have it. But as long as you do that, it really doesn't matter where that money is coming from.
Okay. Wow. That is really creative. Um, That's very interesting. And you said you're doing a 49 unit project, so it doesn't have to be a house, doesn't have to be a townhouse. You'll even do condos.
Condos, apartments,
Oh,
townhomes, you bet. Anything that's residential real estate.
hmm. Okay. Wonderful. And that's very interesting. I'm thinking of a couple things. Is there anything else that you'd like to share specific to that program? Who are
Yeah.
you looking for ideally? I mean, who would you like to have call you on that type of, I mean, it's probably not the guy working out of his pickup truck, but for this
No,
loan anyway.
no, that's not the builder. Although if you have built a home before, right, this product is not meant for your first time builder.
Hmm.
Okay? It's because it's a whole different animal. It's like you're flipping a home, you're doing your first flip, and it's a $30,000 rehab, to you've upgraded. Now you got a 85, 90, $100,000 rehab. That's a whole nother step up. Now you're adding a room. That's the next step. Well, when you go from that to ground up construction, it's a completely different animal. If you're going to do a fix and flip loan and it's your first time, I can do that. If you're trying to build from ground up, you're going to need to have some experience,
Yeah.
uh, preferably three builds. So who I like to be a resource to is what we call the small to medium size builders, who are doing anywhere between 10 homes a year to about 2,500 homes a year.
Wow.
Okay, so
Okay.
that's the great sweet spot where these programs can really be a benefit to them. And in those cases, they're not like the DR Hortons, for example, and the Lennars, and I mean they all have their own financing. They all have all their own banks. So in most cases, that's not even a way that we can be a resource. But most of these guys aren't, and they're looking for creative options. So that's kind of like the size of the builder. The other thing, of course, that I'll say is certainly it's all about the relationship and making sure everything is successful. So part of what we offer is, okay, now you have the homes being marketed. We're bringing buyers in. We already have a few of the models done, and we're getting people putting some contracts in and putting down payments. Let's make sure that we're pre-qualifying all those people, and maybe even work to give them a builder incentive or lender credit, or different things to incentivize them, of course, to come to you, get pre-approved, so you know that it's the best use of your time when you're out there considering working with particular buyers.
Hmm. Awesome. Well, this sounds great. Another thing I did not know about. So, Ivan, this is
That's great.
wonderful. Thank you for sharing. Everybody that's watching, reach out to Ivan for any type of financing. He keeps bringing these creative, wild programs to us. So we're only going to talk about so many things today, but he has
Mhm.
lots of resources available. Reach out to him. His information will be below the video down below, and he'd love to help. Thank
Absolutely.
you for coming today, Ivan.
Thanks so much, guys.